Bonds are frequently chosen as investment options, yet they often hold an air of uncertainty for many investors. Today, we will delve into the world of bonds, shedding light on what they are and the advantages they offer to your investment portfolio. A bond is a type of debt made by an investor to a corporation or government organization. When a bond is issued, the borrowing party receives funds from the investors and agrees to repay the lent amount plus interest. Bonds are frequently used by businesses and governments to fund various initiatives or to meet ongoing expenses. Many investors choose bonds to protect their wealth while also earning additional income. Bonds are widely used to diversify investment portfolios since they are seen as a lower risk alternative to stocks. Let's take an example to illustrate how bonds work. The city of Fairview has plans to construct a new baseball stadium and aims to gather funds by issuing bonds. Each bond represents a $1,000 loan that Fairview commits to repay within a period of 10 years. To make these bonds more enticing to investors, Fairview agrees to provide an annual interest rate of 5%, also offered to as the coupon rate in the bond market. An investor decides to purchase the bond as its face value of $1,000. Moving forward in time, we see that the city of Fairview honors its agreement by paying $50 annual payments to the investor. These regular interest payments will continue for the entire 10-year term of the bond. When the bond matures, the investor redeems it and Fairview restores the initial $1,000 main investment. This bond shows to be a win-win situation for both the city and the investor. Fairview successfully secures the necessary cash for stadium construction, while the investor benefits from consistent interest payments and the eventual return on investment. Bonds are frequently viewed as a dependable and steady investment option because of their predictable payment schedule and the guarantee of recouping the principal amount. There are significant differences between the experience of owning a bond and the experience of owning a stock. Profits and losses are determined by market forces, making outcomes less predictable in general. Bonds, on the other hand, provide a more structured experience with consistent payments. However, it is critical to understand that, like any other investment, bonds are not without risk. Bond investors incur a huge risk when the issuer fails to repay the main amount. This is known as default risk. Bonds with higher default risk typically have higher coupon rates. The level of risk is determined mostly by the issuer's financial soundness. Governments, for example, are frequently seen as stable issuers and provide bonds with relatively lower coupon rates. Corporate bonds have a larger risk of default than other forms of bonds since corporations can go bankrupt. As a result, to compensate for the additional risk, corporate bonds frequently provide higher coupon rates. Various credit rating organizations assign ratings to various bonds, providing bond investors with information about the issuer's financial strength. When evaluating a given bond, it is best to take these grades into account. It is important to note, however, that rating agencies may use various risk adjustment criteria. As a result, before making an investment decision, it is prudent to compare ratings and undertake extensive research on a bond and its related risks. It is important to note that rating agencies are not always completely correct in their assessments. Another risk to consider is interest rate risk, which refers to the possibility that bond values may decline if interest rates rise before the bonds reach their maturity date. When interest rates increase, investors tend to favor newer bonds with higher interest rates. Consequently, if you wanted to sell a bond with a lower interest rate to take advantage of the new rates, you would likely have to sell it at a discounted price to attract potential buyers. Bonds can play a role in a diversified portfolio by contributing to capital preservation and generating income. Many investors combine stocks and bonds to pursue their investment objectives. Since bonds exhibit different movements from stocks, they can help enhance or safeguard portfolio returns. It is important to note that the explanation offered here provides a simplified view of how investors might use bonds and only touches on a few of the issues to consider. Bonds, like other investments, are complex products with a wide range of applications and risks. It is critical to prioritize your personal financial education before investing in bonds. Understanding the complexity of bonds and broadening your knowledge will enable you to make more informed investing decisions. That's all for today's video. We hope you found it useful and interesting. If you enjoyed this video, please like it and subscribe to our channel for more useful information like this. If you have any questions or suggestions for future videos, please leave them in the comments section below. We love hearing from our viewers. Thank you for watching, and we'll see you again in the next video. Happy investing!